Okay, Sheikh, we are going live. I'm muting myself. You can go ahead.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين الصلاة والسلام على رسول الكريم وعلى آله وصحبه أجمعين رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي رب زدنا علما. I welcome you all in this brief webinar on topic financial management, and we will give the Islamic perspective of financial management, inshallah. So as you can see, I am Nissar Ahmad Yatoo, and I am presently as faculty and head Department of Islamic Economics, Banking and Finance at International Open University. So the purpose of this webinar is to highlight the activities of IOU in the field of Islamic economics, banking and finance. So as we are there offering the bachelor level program in this field of Islamic economics, banking and finance for last around 10 years. And Alhamdulillah, we are now in the new semester, Spring 23, and it is our first webinar for this semester in this field of finance. So I will quickly go to this, what is financial management first, because we are discussing here the Islamic perspective of financial management. So it will be incomplete to discuss the Islamic perspective without giving the brief background of what this financial management is all about. So if we see, every business has its certain activities, or it is not limited to business only. We can see every organization, every economy, we can say, every country, we can say, or we can say in personal life also. So we have so many activities, and one of the important activities which we perform on day-to-day basis is the financial activity. And when we look on the finance in large corporations, we call it as corporate finance. And when we look finance at personal level, so we can call it as personal finance, right? So whatever it is, so at every stage, whether it is at every scale, whether it is the small or whether it is a big, so we need some type of management of our finances. So financial management is, it means planning, organizing, directing, controlling the financial activities. So when we see it is financial management, and you must be knowing, some of you, that what management is. It is planning, organizing, directing, and controlling. And when we link these steps of planning with the finance, so we call it as financial management. And it is concerned with acquisition and use of funds. So we have two-way activities in finance. So where from to get the funds and where to invest that funds, right? So it is, we have on one side a source of fund, and second, on another side, we have the utilization of that fund, right? So how we look into these acquisition and use of funds, it is related to financial management, and how to allocate scarce resources. scarcity resources across assets over time in order to earn a return. So when we see our resources are always limited, but our needs are unlimited. So how we allocate those resources on the basis of priority, on the basis of importance. So it is financial management which tells us how to allocate and what should we invest in. So in which project we should invest and which project we should not. So feasibility of the project, right? So feasibility of investment, we come to know through this financial management. And how do we as individuals or organizations make investment, conduct banking activities, incur debt? So this is all about the financial management. So this is a brief background of financial management. And when we look into this, decisions to take in financial management. So we have some common decisions, some important decisions, main decisions. You can find it in any book on the financial management. The capital budgeting means investment decisions. So when we have some fund in hand, so we raise funds. So where to invest this fund? So this is capital budgeting. And second is capital structure, means financing decisions. So where from to bring the funds in the business. So whether it is debt, whether it is equity, what is the proportion of debt to equity? That makes our capital structure. And working capital management. So how much amount of the assets, capital, right? So which we have, we are investing in the working capital, right? So we are using that as working capital for day-to-day operations, and how much to pay as returns to the investors in the firm. So these are the major decisions we take in financial management, and in each and every decision. So we have to look into the Islamic perspective, Islamic aspect, right? So how to take all these decisions. So how to make all these decisions Sharia compliant. So this is actually the focus of this webinar today. And major goals. So through financial management, we ensure survival of the business, survival of the organization, survival of our personal life, right? Or avoid financial distress and bankruptcy. So we plan in advance to avoid the financial distresses and bankruptcy in future, and beat the competition. So through efficient means of investments. So when we manage finances effectively and efficiently, so we can compete in the market and we can maximize sales or market share through the finances. So through the proper utilization, proper allocation of funds to the different activities. And one of the important function or goal of financial management is to minimize the costs. So at what cost we are giving the service, at what cost we are actually providing the products, and to maximize profit. It is one of the important goals, and maintain steady earnings growth. So these are the goals of financial management. So this is the purpose of financial management in an organization. So when we look into these very goals, right? So how these goals are Sharia compliant? Why are these goals contradictory with Sharia, right? So this is actually that perspective we are discussing today in this webinar. And major functions we have already discussed it is procurement of funds. So how we procure the funds. So when we look into the balance sheet of a company, so it is reflected on the balance sheet as liabilities. So where from the funds we have taken. So on what terms and conditions. So what a percentage of funds is in terms of equity shares, what percentage of funds is in terms of loans from banks, right? So that we look into this when we look in the major functions. And utilization of funds, it reflects the asset side of the balance sheet. So balance sheet is very important to check the financial activities of a firm, of a concern. And through the balance sheet, we can look into how Sharia compliant a business is, how the financial management of a particular business are as per the Sharia principles. And when we see the overall process, so when we launch a business, so on one side we have a firm, right, in which we have to invest, And on other side, we have to raise the funds from the financial markets. So a firm issues securities. It could be the shares, it could be bonds, debentures, and they raise funds from the financial markets, whether these are short-term debt, long-term debt, equity share, right? And second step is then we invest that fund and we generate cash flow for the firm by investing in profitable projects, right? So when we generate the cash flow, so out of that cash flow, some part is actually paid as taxes on our returns, and some part is paid as dividend or debt payments. So we are settling back the debt, or we are paying dividend to the shareholders, and some part is retained for the further investment, right? So this is the overall process we have. So ultimately, the firm must be a cash generating activity. So on that, when a firm is a cash generating activity, so it can pay its taxes, it can pay dividend, and it can retain some part of earnings and expand the business. And the cash flow from the firm must exceed cash flows from the financial market. So what cash flow is from the financial market means what amount of debt they have taken from the market. If the firm is earning more than that, that what they have generated from the market, so means they are making profit on that fund. And that is actually how investments work and how is the overall process of this investments management. And when we look into the whole process, the financial management, when we look into the balance sheet, when we look into how firm how a firm raises funds from the market and how it utilizes and how it invests it in to its business activities and generate profit, right? So when we look into Islam or Sharia, it has two main parts. One is ibadat and second is the mamalat, right? So ibadat is the relationship of man to God, means man to Allah, right? And it is ibadat, and mamalat is man-to-man activities. And these in man-to-man activities, there are different activities, political activities, economic activities, social activities. And this is an economic activity, right? When we look into the financial management, it is concerning the practicalities of the daily life in various forms of man-to-man activities. And one of the important activity is the economic activities, and it falls in this mamalat, right, in Sharia. And when we see the approach of Islam, so Sharia is based on two main sources. One is Quran and second is Sunnah, or we can say Hadith. So if you see the Quran itself, there are more than 80 verses in Quran, which is a primary source of Sharia, one of which is the longest that relate directly and sometimes indirectly to the subject of business economics. So what we call as Ayatu Dain. So these are in the last verses of Surah Baqarah, right? So these are the longest verses in Quran. So Ayatu Dain. So including those, there are total of 80 verses in Quran, which are related to the subject of economics, business, contracts, right? And interest is one of the main topics which is mentioned in 12 verses. So there are different aspects related to a business, economics, finance, right? And one of the important aspect which is discussed in the primary source of Sharia, that is Quran, is the interest, what we call riba in Arabic term, right? And apart from there are numerous evidences from Sunnah related to severity of interest, its definition and prohibition, right? And there are other prohibitions like prohibition of gambling, prohibition of gharar. So all these prohibitions, so when we look into together, so based on those prohibitions, so there are certain principles which are governing the finance, which we call as Islamic finance or Islamic economics. So it is based on all these verses of Quran, the primary source of Sharia, and the evidences from Hadith, right? So so there's a long list of verses, long list of these Hadiths on this, so which we cannot touch in this webinar, right? So I hope you must have actually have gone through those, right? For example, there is one ayat, halallahu bay'ah wa harama riba, right? And another place, like for example, there is ya ayyuhallazina amanu la taqulu riba azafan muzafatan, right? So these are the verses which are purely related to the interest, the riba. And prohibition of riba is one of the main principles of Islamic finance. And when we see these prohibitions, so when we make these prohibitions, the list of prohibitions in Quran and Sunnah, one is the riba, interest. Second is gharar, means excessive uncertainty. When there is something uncertain, so it is prohibited to take these activities. And maisir means gains from games of chances, that is gambling. And fourth is itikar, hooding to bid up prices. So we sometimes hood things to bid up the prices, and producing, trading in haram goods activities, like we have alcohol, sometimes this prostitution, etc., right? So gish, forbidden concealment of information, like the transparency. So which is actually one of the important thing to consider in today's world, because when we look into the statements of institutions, so they are not transparent. So they are trying to put the information as clean as possible, and they try to hide what are the drawbacks. So this falls in gish, and it is actually very prominent in the today's business world, right? So these are the 6 items. So when we look into the items which are prohibited, which are related to business, economics, finance, so we can group them into these 6 categories. And when we look into the basic principles, so these are again based on these 6 prohibitions: avoiding activities based on riba. So where there is involvement of riba interest, we have to avoid those activities. Like second is wealth generation from legitimate trade business, means we should not involve ourselves into the things which are not legitimate, right, to trade, for example, alcohol, etc. And asset-based investment. So whatever investment we are doing, so there should be some real asset backing this. So when we look into the present world, we have the market like cryptocurrencies, etc., right? So they are not backed by anything. So that is why they are actually prohibited, right? Because they are not backed by some assets, they are not regulated. And investment should have social and ethical benefits beyond pure returns. So if there is only return and there is not any social or ethical benefit, so we should avoid that, and risks should be shared. So whatever risks we have in business, so those should be shared. It should not be shifted to one person, right? For example, when a bank gives a loan to a person and he has or she has to invest it, all the risks are on the person who is taking the loan, right? So banking is only taking the fixed percentage of interest, right? And all harmful activities should be avoided. So these are the basic principles, so which are based on these main prohibitions, which we have listed in earlier slide. And major contradictions, like when we look into a business based on these principles. So first we look into the type of business, whether the business is legitimate. For example, if a business is not legitimate, for example, we are doing the businesses, for example, on alcohol, it is dealing with pork. So these are actually, we are contradicting to Sharia principles into the type of business itself. So then we will not check whether the source of fund is on basis of interest or not, because the business itself is not legitimate. So first contradiction we look is the type of businesses. And second is the kind of financial instrument, investments. So how the business has raised finance. So whether they have raised the finance through the debt securities or through the equity, right? So that will decide the second point. And third is the nature of assets backing an instrument. So whether the asset backing an instrument is a real asset or it is a fictitious asset, right? And relationship between investor and issuer, whether it is profit and loss sharing. It is okay. If it is not profit and loss sharing relationship, means there is risk or it is based on interest. So investor is taking interest. So whatever fund he is providing, right? So this is actually violating the Sharia principle and how the risk is shared between the two, right? So this is the risk taking. So based on these factors, we check whether a business is Sharia compliant, whether it is financial Sharia compliant, where are the contradictions. And after this, we have based on these principles, there is the concept of this Islamic financial management. So management of finances in accordance with Sharia means they should not take riba, they should not be involved in the businesses which are not legitimate, right? So there should be profit and loss sharing. So there should be risk and risk sharing, right? So there should be avoidance of this gharar, gambling. So following Sharia guideline is in increasing, creating, protecting, and purifying and distributing wealth, right? So at every aspect. So a business is following the Sharia these guidelines. So this is what is Islamic financial management, what Islamic financial management teaches, and how to procure and use funds based on Sharia guidelines and determining financial goals, priorities, resources to be met optimally within the parameters stated by Sharia. So this is what is Islamic financial management, okay? And after this, we have the Sharia screening of financial activities. So when we look the financial activities, we do the screening of those activities based on these Sharia principles. Like we have industry business-based Sharia screening, checking in which sector the organization is operating. For example, if the organization is operating in a sector like alcohol, if an organization is operating in a sector like haram to this entertainment, right? So we reject the business at industrial level, right? So this is the first industry business Sharia screening. So there is no relaxation. So if a business is actually promoting something which is not permitted in Sharia, so it is actually, there is no relaxation, and we have to be very strict when we do the financial screening. And second stage, when a business passes, for example, if it is doing in electronics, if it is doing in, for example, education, if it is doing in other halal goods, right? Then we go for the second stage of screening, that is accounting or financial based Sharia screening. So what are the sources of funds? Where from the funds come? Whether the funds they have generated from they have taken on the basis of interest, or they have taken on the basis of equity, or we can say profit and loss share. So there is some sort of relaxation, and it is decided by different factors, and these factors may vary from place to place, country to country, right? So it is actually decided based on the different factors, socio-economic factors, religious factors, right? So what kind of society people are living in. And there is some benchmark for this to make, when we do the screening, accounting and financial based Sharia screening. So there are some benchmarks the institutions follow, or the financial analysts follow, and they invite a role of proper Sharia board. So, right, who are guiding the financial experts, or who are supervising the financial activities, and they define certain benchmarks. For example, how much percentage of debt is accepted in balance sheet? For example, we cannot expect a balance sheet which is 100% debt-free. So sometimes the scholars may give 5% relaxation in some situation. Sometimes they may give 10% relaxation in another situation, right? So this is the second stage of screening, and it is very important related to the financial management. And when we look into, for example, the Standard & Poor's 500 Sharia index, it is US-based index. So they have actually 4 stages of screening. One is qualified in business screening, means if a business is halal, it is not haram, means it has qualified as a business, as a Sharia compliant business. And second is checking the leverage position. So how much percentage of debt they have in total capital. So if it is not exceeding 33%, it is qualifying the second stage. And the stage third is checking the cash position. For example, it tells us accounts receivables, shareholders equity, right? If it is less than 49%. So means whatever assets we have, out of the assets, only less than 49% is actually as receivables. It is yet to collect from the market. So it is qualifying. Our cash plus interest divided by shareholder equity is less than 33%. So these are the benchmarks. So of this S&P 500 share index. So it is stage 3, and stage 4 is non-Sharia compliant income. For example, income from interest resources, total revenue, right? So if it is less than 5% is from non-Sharia compliant, so it qualifies at the stage 4. So likewise, we have numerous indices across the world, right? For example, if we talk of this India, we have Bombay Stock Exchange, and they have a Sharia index called Taqwa Advisory and Sharia Investment Solutions, right? So they have the Sharia index. So it is based, that has been developed based on certain parameters. So these benchmarks, right, this percentage, 33%, 49%, so it may change from one place to another place. It depends upon the economic situations. It depends upon the size of population, Muslim population in a particular country, right? So this is actually how Sharia indices are developed, and these are related to the financial management. And there are Sharia alternatives. So when we look, for example, there are different products based on Islamic finances through which we can actually make best use of finances. So we may generate best finances, Sharia compliant finances. So we classify those products as sale-based products, partnership-based products, fee-based products, lease-based products, right? So in which we have the Murabba, Cost Plus, Istisna, Salam, Tawarruk, Urban, right? So these are the aspects which we cannot explain here in the short webinar. I'm just giving you the gist. So you can take these and you can study about these in detail. So how they provide alternative to our conventional financial management, to how we can make our financial management as Sharia compliant, right? So these are the different Sharia alternatives we have, and based on these alternatives, so we can make use of these alternatives as a source or utilization of funds. For example, Murabba, we use it in working capital for asset acquisition. So underlying asset is tangible asset. Ijara, we use it in operating financial lease. Istisna is construction, project financing. Mudaraba is deposit working capital for business. Musharaka is working capital for business and asset acquisition, right? So likewise, we have Tawarruk, Wakala, Sukuk. So I cannot explain all these aspects here. So these are the aspects to self-study. And when we look into the major financial statements, so in the conventional financial, in the conventional finance or conventional financial management, so we have 3 main financial statements. One is balance sheet, second is income statement, and third is cash flow statement. And there are some other statements like fund flow statement, etc. But apart from these 3 main financial statements, In Islamic financial management, there is financial statement reflecting the bank's function as investor. So the financial statements will reflect assets like mudaraba, musharaka, right? So those will be reflected in the financial statements when we prepare the financial statements with Islamic financial management. So these are the various aspects. So we cannot actually explain all these because people, the audience in this webinar may be from different backgrounds, right? So this is a purely, these are pure financial terms. So those who are from the management background, commerce background, or economics background, so they can understand. So for those actually who are not able to understand these aspects, so we can say that in Islamic finance, there are numerous sources of funds. And there are numerous ways to utilize those funds. But if we see the conventional finance, we have only in conventional banks, if we see, so there is only one kind of deposit. So that is either a fixed deposit or saving deposit, right? Whatever it is. So it is based on interest. But in Islamic financial and banking system, so we can create a different variety of deposits. So based on different terms and conditions, so which are not violating the Sharia principles. So the points of difference is, again, I will say the items in the financial statement. The ratio analysis is actually one of the important function of financial management. So in which we check the debt to equity. So, or we can say, what are the earnings? So there are some extra ratios in Islamic finance because we are taking into consideration other aspects also. And there is reflection of unique payments like zakah. So in addition to the normal taxes, which are in the conventional finances, so there is a unique payment like zakah, and it is reflected in the financial statements of a concern. So elements in balance sheet, on the asset side, there are physical assets plus interest-free financial assets. And there are murabba, ijara, istisna, salam. So these are actually the interest-free financial assets. On the liability side, there is equity share capital, reserves, retained earnings, and Sharia alternatives of interest-based debts. So these are the main elements in the balance sheet. And so with this, actually, we have come to the end. Because when we look into the financial management, so end product of the accounting and finance. So when we do, it is the preparation of statements and how the statements are different in the Islamic, how the statements are different in Islamic finance and conventional finances. So it is, these are different. So based on these items. So what are the, on the asset side? So we have the items like murabba, ijara, istisna, salam, mudaraba, musharaka. So which are actually created, which are actually provided as an alternative to the interest-based products. And on the liability side, again, there are Sharia alternatives of the interest-based debts, right? So this is how they are different. I hope it is clear. So now I will quickly take the questions on this, if there are any questions. Question is, why choose IIU to learn about economics and finance other than Islamic perspective reason? So when we see this IIU, we have a degree in Islamic economics, bank and finance, which is a blend of this conventional economics and Islamic economics, right? So why you choose? So when you choose IIU, so you can actually learn both aspects, conventional aspect as well as the Islamic aspect of economics and finance. So plus, alhamdulillah, we have the accredited degree in Islamic economics and finance. So you can choose IIU as, so you can choose to study at IIU for your career in economics, finance, and especially in Islamic finance. So example of gharar is means, for example, when there is something uncertain. For example, it has been prohibited in Islam to buy a calf of a camel in a camel's womb, right? Or for example, when we look into, for example, it has been prohibited to buy some fruit which is only a flower on the tree, right? It has not yet formed. Gharar means the outcome is uncertain. So we are not sure about so how much we will get. For example, if you see gharar, so gharar is the uncertainty in something, right? For example, you are not certain about so what. For example, if you are buying some field, right, and you have not proper calculation how much it can generate for you, right? So if you are not expert in this and you are not you cannot you cannot estimate with clarity so how much you can generate from a project. So means there is uncertainty. Okay, so this is gharar. Any more questions? So what will be the main factors we will be focusing in bachelor's program? So in bachelor's program, we have actually the modules from three main areas. One will be on the basics of economics, and second is the finance, and third is the accounting. So these are the main modules you will be learning. So when at the bachelor's level, you can gain a good knowledge in the field of accounting and finance, and on the basic principles of economics, right? So how economies perform, so you can get knowledge of that, money, economics, etc. So we have actually the modules on accounting. So which on one side we have the principle of accounting, basic accounting, and on other side we have the accounting for Islamic financial institutions, or what we call the this Islamic accounting. On one side, for example, we have the capital markets, and on other side we have the Islamic capital markets, right? So this is how we do it. So if you want to study MA, do I need a bachelor's degree? Yes, in master's degree, you need actually the bachelor's degree from any other institution which are relevant, right? Okay, right. So let us wait for 2 more minutes and then we will wind up, inshallah. So the payment of actually taxes and zakat, it depends upon the kind of economy you have, right? So if At certain places, the payment of zakah is exempted from the taxes, right? Okay, it depends upon the country's law. So we cannot generalize this point. I hope this is the last question, right? Yes, we can conclude it for now. سبحانك رب العزة عما يصفون وسلام على المرسلين والحمد لله رب العالمين. السلام عليكم ورحمة الله وبركاته.